Welcome to the Explainer. So, if you're a BS accountancy student, you already know the deal. The Management Advisory Services, or MAS, section of the board exams is notoriously tricky. But today, we're literally hacking your cognitive load to lock in the foundations of tactical decision-making for the LECPA. We are totally bypassing those tedious textbook read-throughs and instead jumping straight into a high-yield, brain-friendly format. The goal here is to help you retain this information for the next 3 years so it's right there, ready to go when you finally sit for your boards.
So how do you make the perfect business decision? Well, in the real world, and honestly, especially on your board exams, you're going to get hit with a massive wall of financial data. To actually make the perfect choice, you have to know exactly which costs matter and which ones are just distractions. Basically, management accounting is all about cutting through that noise to find the actionable truth.
We've structured this explainer into 5 high-yield parts. We'll cover cracking the decision code, ghosting your sunk costs, the relevant cost roster, total versus differential approach, and finally some specific brain hacks for the LECPA.
Okay, Section 1. Cracking the decision code.
Let's decode the absolute bedrock of tactical decision-making. Before we even look at specific numbers, we have to understand the structural rules of how costs are classified in MAS. And the absolute golden rule here? A relevant cost must meet 2 strictly enforced criteria. First, it has to occur in the future. Second, it must be different between your available choices. If a cost is exactly the same no matter which path you take, it just cancels itself out. Like, let's say you're deciding whether to drive or take the train to a client meeting. But either way, you're going to buy the exact same P100 cup of coffee beforehand. That coffee, totally irrelevant to your transportation decision. It's in the future, sure, but it doesn't differ.
Moving right along to Section 2, ghosting your sunk costs.
Now let's talk about the expenses you need to completely ignore. In Gen Z terms, we are talking about ghosting your sunk costs. These are basically your financial X's, and you have to leave them in the past. Bygones are bygones. That is the ultimate analytical maxim for sunk costs, and you will absolutely see this tested time and time again. Because these costs have already happened, they literally cannot be changed by any future action you take. For example, say a company spent a massive sum on a 5-year-old truck last year. The amount paid for that truck is a sunk cost. The transaction is done, it can't be undone, so it has absolutely zero impact on future cash flows. You have to aggressively ignore it when making decisions.
To really lock this in for the LECPA, remember that your brain learns best by contrast. Group your opposites together. Relevant costs look entirely to the future. They're actionable, they're dynamic. Sunk costs, on the other hand, are like the unrecoverable book value of an old factory machine. They are stubbornly trapped in the past. And hey, any accounting depreciation expense related to that past purchase, also a sunk cost. It's really just spreading out a past mistake or purchase over time. Ignore it.
All right, Section 3, the relevant cost roster.
Let's do some rapid-fire flashcard-style definitions of the structural classifications you absolutely must master for the exam. This is pure high-yield vocabulary. First up, differential, or incremental costs. These represent the exact net financial difference when you choose one alternative over another. If buying the standard machine costs P50,000 and the deluxe model costs P60,000, your differential cost is exactly $10,000. It's just that incremental leap from option A to option B. And remember, differential costs are always relevant. Next, we have avoidable costs. Think of these as the specific expenses you actively save or dodge entirely by making a specific choice. So if you decide to stay home and watch a movie on a streaming service instead of going to the cinema, the cost of that cinema ticket is an avoidable cost. You literally avoid it by changing your action. Just like differential costs, avoidable costs are always relevant. Out-of-pocket costs are pretty straightforward, but examiners love to test this concept just to make sure you know the difference between cash and non-cash expenses. These represent decisions that require you to spend actual cash or incur a real liability right now or in the very near future. It is a highly relevant real-world drain on your current resources. Then we have postponable costs. If you can kick an expense down the road to a future date without hurting the business today, like, say, deferring routine aesthetic maintenance on a building, you are looking at a postponable cost. Recognizing these gives management some much-needed breathing room when cash flow is tight.
And finally, opportunity cost. This is essentially the FOMO, the fear of missing out, of accounting. It's the quantifiable economic benefit you sacrifice when you choose one path over another. For instance, the salary you sacrifice by choosing to sit in a CPA review center instead of working a full-time job, that lost income is your opportunity cost. It rarely appears in traditional accounting journals, but it is deeply, absolutely vital for internal decision-making.
0. That is the exact amount of weight, relevance, and attention you should give to sunk costs when you are calculating these future-oriented problems. Seriously, do not let the examiners trick you into adding a past cost back in your differential analysis. The answer to how much should this sunk cost impact my decision is always 0.
Section 4. Total versus differential approach. Let's compare the two ways to analyze all this financial data. The traditional total approach forces you to build complete income statements for every single option, combining both relevant and irrelevant data. It takes forever. The differential approach, however, isolates only the changing items. It trims the fat. This saves decision makers and, way more importantly, you during a time-crunched exam, tremendous amounts of time and effort.
The crucial takeaway here is that isolating relevant costs is basically a defense mechanism. Mingling irrelevant past costs with relevant future costs causes massive confusion. It distracts you. If you try to use the total approach under exam pressure, you run the very real danger of accidentally subtracting a sunk cost or failing to realize that an allocated fixed overhead cost won't actually go away. Isolating relevant costs hones your quantitative analysis and prevents total disasters on your board exams.
And finally, Section 5, Brain Hacks for the LECPA.
Okay, to lock these concepts into your long-term memory for the next 3 years, you need to internalize this survival checklist. You're going to need these concepts embedded in your brain. 1. Ghost your sunk costs. Bygones are absolutely bygones. 2. A cost is only relevant if it is both in the future and different between your choices. 3. Opportunity cost is your foregone FOMO benefit. 4. Use the differential approach to isolate the changes and save yourself time. And 5. Avoidable costs are your saved expenses.
I want to leave you with this final, defining question. Ask yourself this every single time you face a complex, convoluted board problem. If I can't change a cost with my next action, why on earth am I calculating it? If you can't change it, drop it. Cut through the noise, isolate the differences, and you'll find the right answer waiting for you. Thanks for joining this explainer, and happy studying.